Hi, thanks so much for tuning in. You're watching the Mutual Fund Show on NDTV Profit, and my name is Alex Matthew. Let's talk about what the show is all about. It is, in fact, the show that gets you actionable insight on everything mutual fund related. On today's program, we're discussing fixed income mutual funds and whether or not you should opt for corporate bond funds or, in fact, look at credit risk funds which have fallen out of favor, as you know. Is it the right time to reconsider whether to invest in those or not? And then we'll talk about actively managed mid-cap mutual fund schemes. They've seen significant inflows right from the start of last calendar year, and for very good reasons. They've seen significant outperformance as well. But as in life, in mutual funds, you have winners and losers. And on today's program, I'd like to talk about the underperformance in that period of time. There are a few schemes that are underperformed over a 3-year period, as is the case in most categories. We'll talk about the reasons for those underperformances, and we'll talk about whether or not you should consider removing these schemes from your portfolio or whether patience would hold you in good stead instead. Let's introduce you to the guests for today. We've got Santosh Joseph, who is a founder of Germinate Investors Service, and we've got Rushabh Desai, who is the founder of Rupee with Rushabh Investment Services. Thank you so much to the both of you for taking the time, as always. Santosh, I'll start with you on the fixed income conversation, and really what I wanted to start with is active versus passive, and I want to talk about the slightly longer term options in the segment of fixed income. How do you first of all choose whether you want to go the active route or the passive route?
Well, to begin with, if you clearly know that passive is for you, that's when you choose the passive. But in an active fund, you have the luxury of the fund benefiting with the significant amount of dynamism that is there in the market. Therefore, the simple answer between active and passive would be if the client already has got a well thought out or defined strategy that why he's looking at passive and how this is going to help him meet his financial goals. If not, it's always better and also recommended that you be in active strategies, because in the active strategy, the dynamism, the real-time activity of the market ground realities is factored in and essentially goes on to benefit the client a lot more than just the difference between active and passive thought.
That's a fair point. I want Rushabh, you also to come in on this because, and the reason I ask is because you have FMPs, fixed maturity plans and target maturity plans, or rather, in fact, more the latter than the former. Target maturity plans, because of the flexibility that they offer you, that have come to the fore in the recent past. And by recent past, I'm talking about the last couple of years or so. Do you also believe what Santosh is saying? Is that the case with you as well?
Alex, thanks so much for having me on the show. Yes, absolutely. I do agree with Santosh that active segment in the debt mutual fund space has more merit because the fund manager can take active calls in terms of, what bonds to buy, what bonds to sell. And because these bonds are also traded, so it's very important that, the fund manager can take full advantage in the secondary market as well. In the active segment, the fund manager also can take duration calls and credit risk calls as well. So I think active debt products will do much better, rather than the passive in terms of delivering better risk adjusted returns. But to simply put it, that if a client doesn't understand all of this, then of course a passive route, a simple roll down strategy works best as well. But also it's very important that because even in the active space, we have different products of different duration as well. So it's very important to match your time horizon and the duration of the product. And especially it's also very important to understand the interest rate cycle as well. So if someone understands, the active side, all the the market cycle and the debt market space well, then I would definitely go for the active debt products rather than the passive ones.
Okay. Santosh, I'll come back to you and talk about, and I know that this has been talked about quite a bit, but since we're talking about fixed income, because of the change in tax treatment of fixed income mutual funds, we're talking about the longer term strategies that have now they don't longer get that indexation benefit, and they're not treated as long-term capital gains at all. So from that perspective, I think a lot of people have gravitated towards other products even outside of the mutual fund industry. Is there still a considerable merit in holding fixed income mutual funds as part of your overarching strategy, in your asset allocation strategy?
There's no doubt on that. I agree that the taxation took the zing off of the luxury that mutual funds gave, and no doubt that capital gain and indexation was a huge benefit to the entire debt segment of the fixed income industry. Now, when you look at a well-managed dynamic fund, now whether it's in the corporate bond space or even in the credit risk management space, there is so much of alpha that can be generated for an investor in a well-managed fund. Risk management, alpha, convenience, liquidity. These are all those simple things. They become priceless and very valuable for an investor in his journey towards, protecting wealth, building wealth, and also creating a very stable portfolio. So, though we missed out the edge of taxation, we still have the benefit of the product itself being superior.
Uh, Rushabh, come in on this as well. What do you tell your clients to do with regard to their longer term strategies on fixed income?
See, currently we are at the peak of the interest rate cycle, Alex, right? So I think medium to long duration funds or bonds would work well. A lot of people, tend to forget this, that mutual funds, especially debt mutual funds, are market linked products, right? The bonds are traded on the secondary market, right? So they are always going to have a higher edge than the traditional bank FDs. The reason is because, see, the bond yields, right, and the bond prices are inversely related. So when the yields in the market, or when the interest rates in the economy starts to fall down, the existing prices of the bonds, which are of the higher coupon, they will be, they will give you higher returns than what they are currently giving. So since, even though indexation benefit has gone away, because these products are market linked, I think currently at the peak of the interest rate cycle, it makes more sense, for investors to invest a higher allocation towards, market like products like debt mutual funds, and also at that too, investing in medium to long duration funds will have more merit at this point of time.
Got it. All right. So then let's get into corporate bonds, credit risk funds, as well as target maturity funds. And target maturity funds, of course, is that passive strategy that we were talking about at the start. Santosh, quickly your view on how to approach these three. Would you advocate getting into any one of them?
Well, see, all three are distinct. Now, I think the simple way to solve these two is quality of credit and the time frame that one is looking at. Now, in a corporate bond, the bonds are stable. You have certain predictability, and there's a end benefit. In a credit risk fund, you're compromising a little bit on the credit quality, but then you're playing for the upside that is potential. Now, in a target maturity product, you are actually trying to see if you can get better return than an FD. So basically, you have a nice spectrum between the three, where on one end you have corporate bond, in the middle you have the target maturity, and towards the other end you have credit risk. Now, if you are looking for high returns, you of course go for credit risk. If you're looking for stable but also in time, you don't want variability, then you go for targeted maturity. Whereas you want top quality and you're okay with a little bit of variation in time, then you stick to good quality rated corporate bond funds.
Understood. Anything to add here, Rushabh, on this one?
Alex, I'm not a very big fan of the credit risk category, unfortunately. I'll give you some data. I pulled out some interesting data. So from 1st of January 2019 to 6th of February 2024, on a 3-year daily rolling returns basis, corporate bond funds actually outperform credit risk funds 75% of this period. That's a huge number, right? Now, during this period, the average CAGR returns generated by corporate bond funds, this is on a 3-year daily rolling basis, Alex, is around 7.4% by corporate bond funds, and credit risk funds on an average generated around 7%, right? Now for calculation purposes, I took 4 popular funds from the corporate bond category, which is Aditya Birla, HDFC, ICICI, Kotak. And from the credit risk space, HDFC, ICICI, Kotak, and SBI. Now, unfortunately, now one might argue that okay, the cost factor, like the expense ratio, can play a very important role. But let's go to the YTM, the yield to YT, the yield to maturities, which is at the gross level now. So credit risk funds are giving only 0.7 to 1% higher gross YTMs than corporate bond funds. Now, I always tell this to my clients that if you want to take risk, go into the equity segment because fixed income space can be more riskier than equities at times. So, fixed income has to be treated for capital protection, preservation, and steady appreciation. So, because there seems to be no merit from the data what I've just mentioned in the credit risk space, so definitely credit risk funds are a big no, and corporate bond funds are a big yes from my side, Alex.
Since the start of 2023, mid-cap mutual funds, and I'm talking about actively managed mid-cap mutual funds, have received thousands of crores of inflows on a net basis. And we've looked at some of the outperformers, but I think it's also important to look at the underperformers. And we've identified a few of them on a 3-year annualized basis. And look, it's always the case. You look at any time frame and you'll find winners and losers. What we're trying to identify is whether or not you should do something with this information, and if at all, what you should do about it. What we found is that DSP mutual fund in the mid-cap category, Sundaram, LIC, Axis, as well as Franklin India, have relatively underperformed. We'll try and figure out whether this has to do with the strategy and the outperformance of certain pockets that have led to the outperformance of other strategies. Santosh, I'll come to you first on this. Of course, you look at value versus growth, and I think that's the first thing that one would talk about, where one has performed and the other has gotten hammered a little bit. But does anything stand out as a commonality between these 5 schemes that I've chosen?
I think you said both the points in your question. One is the relative underperformance.
Yes.
Second is the value versus growth. Now, if I have to break that down further, the last 2 or 3 years, the clear differentiation has been your exposure to PSUs, and within the mid cap and small cap, the difference between value and growth. Now, I also would like try to look at these funds from a 7-year, 8-year, 10-year performance. For the guys who do have a 10-year track record, they're not bad. In fact, on an average, any mid cap that's got a 10-year track record, the return sits at over 18 or 20%. Now, when you look at the returns standalone on a 3-year basis, these are between 15 to 19%. So there is relative underperformance, largely because of the style of investing and the positioning of the fund. So, though it is a little bit disappointing if you're an investor in this fund versus the funds that have done relatively so well compared to these funds, but I think you have to look at it from a slightly more larger perspective about the style orientation of the fund and the long-term activity of the fund being invested, maybe in growth or maybe not in value or maybe not in PSU. So there is merit if you look at it from a slightly longish point of view, because these funds are not bad. They do have a significantly better 5-year, 10-year performance track record. And these kind of style biases and even sectoral weights or even theme weights can hurt you in a 2 to 3 year performance.
Santosh, and I'm so glad that you pointed that out. The reason I selected 3, because my natural instinct would have gone to at least 5. The reason I've selected 3 is because you, as well as all our viewers, also will know about this, the number of investors that have come into the fold over the last 3 years, and they will have witnessed this performance. So it's important for them to understand, based on what they're seeing on their screens and relative outperformance of perhaps their neighbor selections, what they should do with it. So do you have anything to add on that, Rushabh, in terms of these particular schemes?
Alex, you absolutely put it quite well. You know that because a lot of investors, what happens is they look at past performance of these particular funds and they venture into these funds looking at the great outperformance what these funds have delivered. I do agree that these funds have had a great track record since their inception, but unfortunately, recently, since past a couple of years, on a 7 to 10 year daily rolling basis, returns basis, all of these funds are unfortunately struggling to give out performance. Now, if you see the entire mid cap category, Alex, apart from these funds as well, there are so many funds which are underperforming on a 5, 7, and a 10-year returns basis. Now, see, 3 years again is a very short duration to measure and outperformance and underperformance. And even on a 5-year basis, a fund, it's very natural that a fund can underperform. On a 7-year basis, probably a cyclical product may underperform. But I feel that if a fund, on any fund, whether it is of a value strategy or a growth strategy, it underperforms on a 10-year basis, it's something to be concerned of, and it's something to be worrying, right? So I think apart, I honestly don't recommend these funds apart from Axis Mid Cap Fund at this point of time. Mainly because Shreyas has been with these funds since the inception, and he's been managing it quite well. We have seen management changes in Sundaram, in LIC, in Franklin at this point of time. So I would not recommend additional inflow at this point of time in these funds, but one can look at other consistent performing funds, for example, like Edelweiss Midcap or Kotak Emerging Equity at this point of time. Also, one more thing, Alex, I would like to mention is that investors can start looking at smart beta mid cap index funds. I pulled out some very interesting data that mid cap 150 momentum 50 index. It has outperformed on a 10-year daily rolling basis since its inception vis-a-vis the Nifty mid cap 150 TRI index. So it's high time that fund managers and the AMCs pull up their socks, especially from a 10-year perspective. Otherwise, smart beta index funds would also do great.
Yeah, fair point. Last thought, Santosh, on this very quickly. I think you've already made your point, but any call to action you would give as Rushabh has just done?
See, I think there are 2 points to this. Number one, do you trust your portfolio manager or the fund manager who's now in the helm being able to manage this downturn in terms of performance, though relative? Can he be able to pick up when the tide turns for him? Or is there reasons that you believe that even if the markets were to pick up, the fund will not pick up? That's the first question that you would ask yourself. The second thing that you have to ask yourself again in this portion before you take a call on to continue, not to continue, to even to invest is that the underlying portfolio and the market performance and what you want out of it, are the three in line? Because there are some times where even though there's relative underperformance, the portfolio manager is not keen to make changes, or he makes so much changes that even in future you're finding it difficult to capture that performance. So the only time that you can make an easy decision in a tough situation like this is there some good activity or comfort that you're getting from the fund manager, saying that even though on a 3-year basis I've not made as much as returns as the market has given or the peer group is given, but can I continue to trust the fund manager and play for a bounce back? That's the most critical part.
Fair point. All right, gentlemen, we have time for a couple of queries, hopefully. The first one I will take is from Shrikant, and he's asking on behalf of his father. He says that his father is retired, aged 65, has an amount of 50 lakh that he's invested in Sundaram Flexi Cap and mid-cap funds put together. Now, he's not named the mid-cap funds that he has invested in, but he's asking essentially whether or not these should be held on to. This is a lump sum investment that was made in 2021. And he's earning a monthly income of over 1 lakh through property rentals as well. Is it advisable to transfer to debt-based or debt-based funds in the fixed income space? This is essentially what we've discussed today. So what I'm understanding from that is, do you remove some of the investments from equity, some of the gains from equity, and reallocate towards fixed income? Santosh, I'll come to you.
Well, it looks like a good investor who's got some money and income coming from him, though he's retired. I'd go with a slightly more practical approach, saying that this money should continue the way it is, not essentially remove money, because the markets have made you money since 2021. Because I think now if you're an investor in 2021, there'll already be reasonable amount of gains, whether in a mid cap or a flexi cap fund. I think you should let it continue. The reason you move out of this or book profits is only when you know that you're uncertain about where the market is going and you need income to be drawn from this, or you need some accrual to benefit for your monthly or your life sustenance. there is no clear vision whether the person needs money from this for sustenance. So I think he's done a good job by investing, and he should continue. If ever he's worried, he can move to little more conservative approach like a balanced advantage fund. But there's no reason to panic and move into debt funds.
All right, that's the view. Second question is coming from Samir Kankal. He's writing in from Oman. He says he's 49 years old. He wants to invest 50,000 rupees per month and a 20 lakh lump sum in mutual funds. He's looking for a steady fund to invest in, and he's anticipating returns of 12%, I would think, on a long-term compounded basis. He currently has investments worth 40 lakh, out of which 2 lakh are in mutual funds, and he's looking to convert his shares into mutual funds for long-term and steady income. His goal is income for retirement, and he's looking to retire as early as 2026 and for income to start in 2027. Rushabh, unfortunately, I'm not giving you too much time to answer this.
Alex, to generate 12% CAGR returns in a very short duration, it's going to be a tough job looking at the current markets at this point of time. I would request him to have a little longer time horizon before he starts the redemption process or the SWP process. Probably give it around 5 to 7 years time frame, and then see how the equity segment performs, and then probably start the withdrawal process. At this point of time, he's not mentioned a lot of things where his 40 lakhs is currently, whether it is in equity or debt. I'm not too sure. But I can put it very simply that, the SIP, he can start an SIP of 50,000 rupees purely into the equity space. He can create a good portfolio of flexi cap, mid cap, and small cap funds. I think that will be well sorted. The 20 lakh lump sum investment he is planning to make, again, I'm not aware about how much percentage allocation is in equity or is in debt. If that 20 lakhs is a reinvestment corpus, from his shares, looking into the mutual fund space, then I would recommend to go in pure equity mutual funds at this point of time. But again, I would not suggest to retire this early, because life expectancy has become longer. People are living for 80, 85, 90 years. We have great healthcare, and plus inflation is also eating up our pockets.
Fair point.
The standard headline inflation is not the same for everyone. So that's what I would recommend at this
Fair
point.
point. And there are a few questions that I have of Samir as well. Perhaps we can get on a call with him and get some of those clarifications and come back to you for a more pointed answer. Thank you so much, Rushabh, as well as Santosh, for joining in and for having that conversation with me. I think it's been a fruitful one. Hopefully my viewers think so as well. That brings us to the end of this particular edition of the Mutual Fund Show. It's been an absolute pleasure bringing it to you. Do stay tuned. Lots more coming up on NDTV Profit.